Hi everyone, my name is Yuri and today I'm going to share with you what's called a velocity banking strategy. This strategy is going to help you pay down your credit card debt, student loans, car loans in 1/3 of the time, saving 2/3 in interest without you having to make more money or send extra payments. You'll pay off your 30-year mortgage in 5 to 7 years without having to make more money or send extra payments. This strategy is truly amazing. It changed my life. I showed how to use this strategy. I showed it to my friends, my family members. Everybody really care about so they don't get robbed by these banks. It's really simple. It's not that difficult as long as you understand it. So the only thing I'm asking you guys is have an open mind. I'm going to show you step by step how to use this strategy. And quick disclaimer, I am not an attorney. I am not a CPA. I'm not a financial advisor. I'm simply here to show you how this strategy works so you could, if you understand it, so you can utilize it yourself and save hundreds of thousands of dollars for the rest of your life. So first things first, what is the difference between, what is a mortgage? Mortgage is an amortized loan. So mortgage is what's called, it's a loan. Loans are single-sided. You can only pay, you can pay it back, but you can't buy nothing with it. Versus lines are two-sided, like a line of credit, like a personal line of credit, HELOC, home equity line of credit, credit cards. Those are lines of credit. You can buy stuff with it, you can pay it back. They are two-sided. Now, before moving on and watching this video, please go on the internet and search Google. If you don't know the difference between amortized interest and simple interest, your next task is Google amortized interest versus simple interest, so you can understand the difference. I don't really have the time to get into it now, so look it up and let's dive right into it. So let me show you what is amortized interest is. So in this example we're using, you have a $5,000 income per month, okay? And usually what people do, you make that $5,000 and you put it right into your checking account. Out of the checking account, you pay your mortgage, you pay your phone, your car, your gas, your food, all of your expenses during the month, literally everything you spend money on. And then whatever you have left over, you either move that over to your savings account, or what a lot of people do, they just end up spending that money on whatever. Or if you have an emergency, you end up spending it. So today we're changing that. You are no longer putting that money onto your checking or savings account. Okay? This strategy does not change your lifestyle whatsoever. You're simply moving your money around differently. You don't have to make more money. You don't have to send extra payments. Your lifestyle does not change at all. So let me show you what we're doing. So in this case, we're using a $200,000 mortgage in this example, and I have a little cheat sheet here. I'm going to show you what this looks like. Let me just write it out first. So this is a $200,000 mortgage we're going to use times 30 months. It's at 6% interest. Payment is going to be $1,199.10. You can actually look it up. This is exactly what the payment is, and I have a cheat sheet here. So principal is 200. Your payment is $1199.10. 360 months, which is 30 years. Your principal borrowed was original balance is 200,000. Your payment's 1199.10. So you're going to pay back interest of 231,676. So your interest, just interest alone, is $231,676. Okay, so that means your total loan you're gonna pay back on a $200,000 mortgage, you're paying back $431,676. Does that sound like 6% to you? Doesn't sound like 6% to me. I'm gonna show it to you. It's actually 116%. It's 115.83% to be precise. That is insane. That's crazy. I personally I didn't know the banks make this kind of money. But they do, and it's legal. So, and this is if you don't refinance. This is if you just keep your payments the way they are, just regular for 30 years, you're gonna pay this kind of money. If you refinance, I don't even want to think about it. But I'm gonna show it to you. And I'm gonna show it to you on a quick little graph here, so you can understand it better. So we're gonna use my ugly little hand-drawn graph. So this is month one, year one, I mean two, whatever. This is gonna be this is gonna represent a 30-year mortgage. So this is year 30. Somewhere in the middle, this is gonna be, let's say, year 15. This is year one. Our payments are $11.99 and 10 cents. So here we're going to represent our principal of $199 and 10 cents. This is our interest. It's going to be $1,000. So just like this graph shows here, our payment one principal is $199.10. Our interest is $1,000. So our principal goes like this. Our interest goes something like this. Somewhere in the middle, about year 17-ish, this is where your payments break in half. Half goes to principal, half goes to interest. Okay? Now, how do we win this challenge? How do we pay off this mortgage quicker? And before I go there, usually year 5 to year 7, somewhere in between here, you receive a phone call. Your bank calls you. Hi, Mr. Smith. This is Wachovia Bank or Chase Bank. We just wanted to thank you for making all your payments on time. You're such a valuable customer of ours. And because you've been such a good customer, because you've been paying so good, we're going to lower your interest rate from 6%. We're going to make it 4.29. That's going to save you additional $300 a month. What would you be able to do with $300 a month, Mr. Smith? Immediately start thinking, oh my God, I can get my children extra books or clothing, or they can go to soccer lessons, or whatever it is you want to do with that extra money. And most people go ahead and they refinance without realizing they are hanging out in this mostly interest area. As you could see here, $1,000 goes to interest, only $199 goes to principal, and you hang out in this area. Some people refinance twice, some people refinance 3 times, and they never get out of this buried area, and banks literally killing you. They're making all the money, and you buried, living paycheck to paycheck, don't know how to get out of this rat race, and that's how the banks win. And I'm going to show you exactly how to change that, starting right now, guys. When I first heard about this, I hung up the phone. I did not believe, not even for a second, that this is true in any way. I spent almost 20 years in the car business. I was a finance manager, I was a sales manager, I was a general sales manager, and I never knew that bank make this kind of money, or you can pay down any type of a loan using this kind of a strategy. So let's start with, you have your $200,000 mortgage. So you still owe $200, you just got the mortgage out. Then you're gonna go ahead, and in this case, well, you have 3 things you can use to pay down any type of a mortgage or any type of amortized debt. So you can have either a home equity line of credit. That's number 1. You have to have good credit for that. Second thing, you can open up an unsecured personal line of credit. So this is a HELOC, as most of you have heard before. This is what's called a PLOC. It's an unsecured personal line of credit. And the third thing is your credit card. So to use these 2, you have to have good credit. Okay? Now, if you don't have good credit, if you don't have credit at all, you destroyed your credit, you can use your credit card. Your existing credit card that you currently have, you can use this strategy to pay down whatever loan you have. Now, if your biggest credit card is a $200 limit, you're not going to be able to use it to pay down this mortgage, or pay down any loan for that matter. So what you're going to do in this situation, you can ask your parents, your grandparents, somebody who already has credit cards with decent amount available credit, at least a couple of grand. Well, it depends on what kind of a loan you're paying off, what big of an amount. Based on that, you should choose how, the bigger your line is, the better. At least a couple of grand would work. So you can ask them to add your name as another user on their credit card, and that company will send you your own credit card with your own name on it, which is attached to their credit card. You're still using their credit, their line of credit, but you can use it to pay down your mortgage. If you need more details on that, if you want me to help you understand it a little bit better, at the end I'm going to leave my phone number so you could reach out to me and I'll help you figure out or plan out what would be the better way for you to attack the strategy or to use the strategy. So let me erase this, and in this example we're going to use a personal line of credit, PLOC, personal line of credit. We're going to open one up for $20,000. So our personal line of credit is going to be for 20K. Okay, 20K. We're not using the whole 20K. We're only using $10,000. Why? Because you have your total income. Your income is $5,000. Okay. Your expenses are $4,200 in this example. Your positive cash flow, so your cash flow in this example is $800. So let's show you how this works. So out of this $20,000 personal line of credit, you're going to only use $10,000, and you're going to deploy that $10,000 towards your mortgage. So now that chops it down, now it makes it $190. Now your balance is $190,000. So then I had somebody ask me, well, now I have an extra loan, and that now I owe $220,000. No, you don't. You still owe $200,000. Why? Well, let me show you why. You open up a $20,000 line of credit. You owe $200,000. You took $10,000. You deployed it towards your mortgage. Your balance is now $190,000. You borrowed $10,000, so you owe $10,000 here. You owe $190,000 here. $190,000 plus 10 is $200,000. You still owe $200,000. You don't owe $220,000. You still owe $200,000. I hope you follow me so far. Now, people tell me, well, but that creates an extra payment for me because now I have a $20,000 line of credit. I deployed $10,000. I have to pay this back. That's an extra payment. I can't have an extra payment. I am living paycheck to paycheck. I don't have an extra dollar to my name. So how am I going to be able to use this strategy? Well, simple. You actually don't have an extra payment, and here's why. When you deploy this $10,000, let's say towards the end of the month, now they're saying your payment is due. Let's say you did this on July 1st. Now July 28th, they're saying your next payment, whatever your payment is, on July 28th. So then you're going to take your full income of your $5,000 and you're going to put it on your line of credit. Now you reduce your amount. Now you don't owe $10,000 anymore. Now you owe $5,000 because you just put $5,000 on here. So minus $5,000. Now you still owe $5,000 onto your line of credit. So we're no longer putting your money onto your checking account. We're not doing that anymore, okay? So what we used to do, as I explained to you before, we used to put that money into a checking. We're not doing that. Now you took your $5,000, you put it towards your line of credit. Now you owe $5,000. Now you're gonna you're going to pay off your mortgage. Now you're gonna pay all of your expenses with your line of credit. So now you're negative $5,000. So now you have $4,200 worth of expenses. So plus $4,200. So now you owe $9,600. You negative $9,200. My math is horrible. Now you owe $9,200. So you pretty much paid it down, and you have positive $800 on here, right? So I'm going to explain to you so you understand this a little bit better. When you deploy your $10,000 towards $190,000 towards your $200,000 mortgage, your balance is $190,000. That's just one payment. Now, if you look on let me grab my pen, and I'm going to show you what this looks like. So your principal was $199,000, your interest is $1,000. Let's find where your $190,000 balance. And I highlighted it for you to see it easily. 190,228, which is 44th payment. So by you deploying that $10,000 once, you're skipping 44 months. One payment, you're skipping 44 months, okay, with just one payment. Now, by deploying your income Let me show you how long it's going to take for you to pay back this $10,000 that you borrowed from your line of credit. So we already established that your positive cash flow after all of your expenses is $800. So $800 times 13 is $10,400. So after 12 months, you're gonna have $9,600 paid off. You're still gonna owe only $400 on your line of credit. So your 13th payment, you're going to deploy $10,000 again. What is that gonna look like? So now your balance is $180,000. Let's find 180. That's 180. You skipped 81 months. It's gonna take you 12 months to pay that back. On your 13th payment, you're gonna send it again. Your $170,000 mark. So from 3 times deploying $10,000, you're skipping 112 months. That's insane. If that doesn't blow your mind, I don't know what does. So, in only 3 payments, in only 3 times deploying this, you're skipping 112 months. It takes you only 13 payments to pay that money off. Okay? I hope you are following. So I'm going to cover this one more time. So you deploy 10,000, you make $5,000 per month. You're going to put that $5,000 back towards your line of credit. You're out of your line of credit, you're going to start paying your mortgage, your phone, your car, your gas, your tolls. However, some things you can't pay with your line of credit, like your mortgage, your car. Sometimes could be your credit card. So in that case, what you could do is hold that money back. Instead of putting all that money onto your line of credit, just hold back out of your $5,000. If you have a car and a mortgage, then take your mortgage payment and your car payment out, put it into your checking account, put the rest onto your line of credit, and then pay your mortgage and your car out of your checking account. Or you can ask your bank, whoever you got your money for your line of credit, your personal line of credit from, you can ask them for convenience checks, not cash advance. Cash advance is a lot higher interest rate. You have convenience checks, it's a lot lower interest rate, very, very low. So you can then take that convenience check and write a check out to yourself for the amount of your mortgage and your vehicle, deposit it into your account, and then take that money and deploy it towards, and then pay that money, pay your mortgage with that money and your vehicle with that money. Okay? If you still have some questions on it, just feel free to comment below or shoot me a text. My direct number is 917-650-3333. If you have any questions, if you want me to help you out, go over something with you, give me a call, feel free, shoot me a text, and I'll help you understand this a little bit better. So let me break this down. Let me show you the end result of using this strategy. So our original mortgage was $200,000. Our interest was $431,000. I'm sorry, our total loan, we paid back $431,000. Our interest alone is $231,676, and this was supposed to be $431,676. Okay, and now I'm going to show you, we have what's called the Velocity Banking Calculator, and I'm going to show you how this works. So here, our original balance was $200,000. Our current balance is also $200,000 because we just opened up the loan. So today is July 9th. I'm using an example as if we sent out this payment today, and we did this today. So $200,000 mortgage at 6% for 30 years. Your payment is $11.99. We're using a chunk amount of $10,000. So this is called chunking. You're pretty much taking out a chunk, deploying it towards the mortgage, and you're chunking down your mortgage. So your chunk amount is $10,000 that we're using. Your personal line of credit is at 7% interest rate. It doesn't really matter what interest rate it is. Even if it's 21%, it's still cheaper than 6% amortized rate. So again, let me repeat that so you guys understand it. 21% simple interest is lower than 6% amortized interest. I just showed you an example. 6% amortized over 30 years, and the result is actually 116%. It's lower than 21% regular your line of credit. Does that make sense? Okay, moving right along. So your monthly income was $5,000. This is your take home. This is after all your taxes paid. Then your living expenses are $3,000. This is for your phone, your car, your everything, plus $1,199 for your mortgage, which is a total $4,200. Leaves us with $800 of positive cash flow. That's the only thing we're using to pay down this mortgage. Here's the end result. Your total interest rate was $231,676. You're saving $153,891, and you're only paying $77,784 worth of interest. So instead of paying this mortgage down in 30 years like we had in the beginning, you're only paying this mortgage down in 11.6 years. Guys, this is insane. 11.6, only using $800 a month of positive cash flow. What if you had $1,600 of positive cash flow? Now this doubles. Now this becomes 5, 55, 58, so 5.8, so 5.8, so 6 years, let's say. You will pay down this mortgage in 6 years versus 30 years with only $1,600 of positive cash flow. Guys, this is mind-blowing. So anyway, again, I'm not an attorney, I'm not a CPA, I'm not a financial advisor. If you guys need any help understanding this strategy, or you want me to use your personal numbers with your income, your expenses, with paying down your mortgage or your credit card or your car loan or your student loan, give me a call. I'll show you exactly how to use it. Excuse me. I will show you how to use your Velocity banking application, and we'll pretty much help you understand it step by step so you don't make any mistakes, and you can use this strategy and show your loved ones, show your family how to use it as well. So with that, I'm going to end it. You have a wonderful day. And if you have any questions, feel free to comment or give me a call at 917-650-3333. Have a great day.